Welcome to our podcast about the stock market. In this series, we'll be exploring the world of investing, from the basics of buying and selling stocks to advanced investment strategies and insights from experts in the field. In our first few episodes, we'll be covering the fundamentals of the stock market. We'll start by defining what the stock market is and exploring its history, followed by an overview of how stocks work and the different types of trading orders used in the market. We'll also discuss transaction costs and how they can impact investment returns. We'll then move on to investment strategies, discussing how investors can build a diversified portfolio and manage risk. We'll talk about different types of investment vehicles, such as mutual funds and exchange-traded funds, and explore how to create a balanced portfolio based on investment goals and risk tolerance. We'll also discuss the importance of research and analysis in making informed investment decisions. Finally, we'll wrap up with a look at successful investors in the stock market. We'll explore the habits and characteristics of successful investors, such as patience, discipline, and continuous learning, and discuss how investors can emulate these qualities to improve their investment outcomes. Whether you're a beginner investor just getting started in the stock market or an experienced investor looking to deepen your knowledge and refine your strategies, this podcast has something for everyone. Join us as we dive into the exciting and ever-evolving world of investing in the stock market. Definition and history of the stock. The stock market is a place where shares of publicly traded companies are bought and sold. It is a market where investors can buy and sell ownership in a company, which is represented by shares of stock. The history of the stock market goes back hundreds of years, to when merchants would gather in coffee houses in London to buy and sell shares in the East India Company. Over time, the stock market has evolved and become more complex, with the creation of new financial instruments such as options, futures, and exchange-traded funds, ETFs. Today, the stock market plays a critical role in the global economy. Companies use the stock market to raise capital, and investors use it to invest in companies they believe will grow and generate profits. The stock market also serves as an important indicator of economic health, with rising stock prices generally indicating a strong economy and falling prices indicating a weak economy. It's important to note that investing in the stock market comes with risks, and investors should carefully consider their investment goals and risk tolerance before making any investment decisions. It's always a good idea to consult with a financial advisor or do your own research before investing in the stock market. Stocks. When a company needs to raise money to finance its operations or growth, it can issue stocks, also known as shares or equities. Each share represents a portion of ownership in the company, and shareholders are entitled to a share of the company's profits and assets. In the stock market, stocks are bought and sold by investors. When investors buy stocks, they are essentially buying a portion of ownership in the company, and when they sell stocks, they are selling their ownership to another investor. The value of a stock is determined by a number of factors, including the company's financial performance, growth prospects, industry trends, and overall economic conditions. If a company is performing well and its future looks bright, its stock price may rise, while if it's struggling or facing challenges, its stock price may fall. Investing in stocks can be a way to grow your wealth over time, but it also involves risks. Stock prices can be volatile, and companies can fail or experience setbacks that can lead to significant losses for investors. It's important to have a diversified portfolio of stocks and other investments, and to be prepared for the ups and downs of the stock market. Overall, stocks are a key component of the stock market, and investing in stocks can be a way to participate in the growth and success of companies across a range of industries. Investment strategies. 1. Buy and hold. This strategy involves buying stocks and holding them for the long term, typically 5 years or more. The idea is to benefit from the overall growth of the stock market and the performance of individual companies over time. Buy and hold investors usually don't make frequent trades and instead focus on building a diversified portfolio of stocks. 2. Value investing. Value investors look for stocks that are undervalued by the market, based on factors such as earnings, dividends, and book value. The idea is to buy stocks that are trading at a discount to their intrinsic value and hold them until the market recognizes their true worth. Value investors often look for companies with solid fundamentals and a history of consistent earnings growth. 3. Growth investing. Growth investors look for stocks of companies that are expected to grow at a faster rate than the overall market. These companies may be in emerging industries or have innovative products or services that are expected to drive future growth. Growth investors often pay higher prices for these stocks, based on their potential future earnings. 4. Momentum investing. Momentum investors look for stocks that have recently performed well and have positive momentum. The idea is to buy stocks that are in an uptrend and sell them when they start to lose momentum. Momentum investing can be risky, as stocks that have performed well in the past may not continue to perform well in the future. These are just a few of the many investment strategies used in the stock market. It's important to choose a strategy that fits your investment goals, risk tolerance, and investment horizon, and to be prepared to adjust your strategy as market conditions change. It's also important to do your own research and consult with a financial advisor before making any investment decisions. Risk and return. When investing in the stock market, investors must consider both the potential returns and the risks associated with their investments. The return is the profit or loss on an investment, expressed as a percentage of the amount invested. The risk is the chance that the investment will result in a loss or lower than expected returns. In general, stocks offer higher potential returns than bonds or other fixed income investments, but they also come with higher risks. The stock market is subject to volatility, which means that stock prices can fluctuate widely in response to market conditions, economic news, and other factors. Stocks of individual companies may also be subject to company-specific risks, such as management changes, product recalls, or lawsuits. Investors can manage risk by diversifying their portfolio, which means investing in a variety of stocks across different sectors and industries. Diversification can help reduce the impact of market fluctuations and company-specific risks on an investor's portfolio. However, diversification does not guarantee a profit or protect against loss. Investors must also consider their risk tolerance when investing in the stock market. Risk tolerance is the amount of risk an investor is willing and able to take on. An investor with a high risk tolerance may be willing to accept higher risks in exchange for the potential for higher returns, while an investor with a low risk tolerance may prefer more conservative investments with lower potential returns. Overall, understanding the relationship between risk and return is crucial when investing in the stock market. Investors must consider both the potential returns and risks associated with their investments and make informed decisions based on their investment goals and risk tolerance. Successful investors in the stock market. 1. Patience. Successful investors understand that investing in the stock market is a long-term game. They are patient and don't get distracted by short-term fluctuations in the market. Instead, they focus on the fundamentals of the companies they invest in and the potential for long-term growth. 2. Discipline. Successful investors have a disciplined approach to investing. They have a clear investment strategy, stick to their plan, and avoid making impulsive decisions based on emotions or market hype. They also avoid trying to time the market or make big bets on individual stocks. 3. Diversification. Successful investors understand the importance of diversification. They invest in a variety of stocks across different sectors and industries to reduce their exposure to company-specific risks and market volatility. 4. Research. Successful investors do their research before making investment decisions. They analyze company financials, read news articles and reports, and consult with financial advisors to make informed investment decisions. 5. Risk management. Successful investors manage risk by setting clear investment goals, diversifying their portfolio, and having a plan for dealing with market downturns. They also avoid investing more than they can afford to lose and have a clear exit strategy in case things don't go as planned. Overall, successful investors in the stock market have a disciplined approach to investing, understand the importance of diversification and risk management, do their research, and continuously learn and adapt to changing market conditions. And that brings us to the end of our podcast series on the stock market. We hope that you've enjoyed learning about the different facets of investing in the stock market, from the basics of buying and selling stocks to advanced investment strategies and insights from experts in the field. In our first few episodes, we covered the fundamentals of the stock market, including its history, how stocks work, and the different types of trading orders used in the market. We also discussed transaction costs and their impact on investment returns. We then moved on to investment strategies, exploring how investors can build a diversified portfolio, manage risk, and make informed investment decisions based on research and analysis. We also discussed the importance of continuous learning and adaptation to changing market conditions. Finally, we wrapped up with a look at successful investors in the stock market, discussing the habits and characteristics that have helped them achieve success. From patience and discipline to risk management and a commitment to ongoing learning, there are many qualities that investors can emulate to improve their investment outcomes. Whether you're a beginner investor just starting out in the stock market or an experienced investor looking to refine your strategies, we hope that you found our podcast informative and helpful. Remember, investing in the stock market is a long-term game, and success requires patience, discipline, and a commitment to ongoing learning and growth. Thank you for listening, and we wish you all the best in your future investing endeavors.